This is Gerardo Del Real with Resource Stock Digest. Joining me today is the president and CEO of Revival Gold, Mr. Hugh Agro. Hugh, how are you this afternoon?
Very good, Gerardo. Thank you for having me back.
Thanks for coming back. The last time you and I chatted, I mentioned that you had teased the first peek at the PEA and the economics surrounding the Beartrack Arnett project, and I mentioned that there wasn't a lot of month left in November, and sure enough, here we are less than a week later with a very, very robust step one. Let me summarize briefly, and then I'll let you provide some context if that's okay, Hugh. You just announced the PEA came in at current prices, at close to current prices, at $19.50 per ounce gold, $200 million NPV, 49% IRR. For the skeptics out there, if you want to take the de-risked price of $15.50 per ounce gold, it's a net present value of $88 million and after-tax IRR of 25%. So obviously a lot of room between $15.50 and $19.50 there, providing a great buffer. And again, I have to advise, this is a step one. This only takes into account a small part of the overall resource. Can you provide some context for us, Hugh? And of course, congratulations.
Yeah, thank you, Gerardo. First thing is, this is a project that's got low risk, is eminently deliverable, and which is, as you say, the starting point for the project. It's only a fraction of the value of the project and the potential of the project, but already you're starting to see 72,000 ounces a year of gold, and all-in sustaining costs just over $1,000 an ounce, and the return metrics that funding parties will find easy to manage. It's a great starter project for Revival Gold. It's the first step along the way as we develop out towards the mill scenario and deliver on exploration to come.
Let's talk about the pre-production capital. You mentioned the potential funding options that are going to open up to you here in the near future if they haven't already. I've seen some research reports on this morning's news that give you a price target of $2 per share. You're, of course, trading at half that, $1 per share Canadian. Can we talk about the inexpensive CapEx to get this up and going?
This is one of the benefits of Revival Gold. We've got all this infrastructure on site. We've now got it. We've now been through it fully with the engineering firm. Some of the top engineers in the land on heap leach projects, and that infrastructure that we have on site gives us a head start in terms of a redevelopment for a really low cost of capital, 100 million, very manageable for a company our size. And if you look at us compared to most of the other development projects out there, our capital intensity ranks at the very low end, and so that makes it a very doable project.
The infrastructure advantage also provides for a very favorable permitting timeline, which of course is critical if you're going to capture the better parts of this gold bull cycle. Can you explain that a bit?
We're on a brownfield site. We've got lots of baseline data. We've also got the aspects of permitting from the prior operation, a plan of operation, and as part of our engineering plan, we managed to keep all of the Beartrack aspects of this project in the footprint of the existing disturbance. So that should make for a much quicker permitting timeline than a greenfield site, or even one where we didn't do the heavy lifting to manage ourselves within the current footprint of the site, and that's a real advantage for the project, as you point out.
This, of course, only includes the heap leachable portion of the resource. Can you talk about the potential, which you mentioned in the release, that you're evaluating for a second phase sulfide milling project?
We've got huge option value here. The resource on the mineralized trend is outlined over about 5.6 kilometers or 3.5 miles. We've got double that in terms of potential to expand the resource. But even within the current resource, we're only scratching the surface with the heap leach. A mill project conceived at the level of production that our consultants RPA conceptualized in the resource would take us to 20,000 tons a day, or 300,000 ounces a year of gold at our current grade and recoveries. So that's a very sizable project. And as we work our way forward with this first phase project, we will continue to pursue exploration and continue to advance towards the mill scenario to follow.
The margins are excellent. Using today's prices, you have approximately $820 in margin, with an all-in sustaining cost, of course, of $1,057 per ounce. That's assuming what the study published was a 60% average recovery. Is there an opportunity to optimize that?
We think, yes, that there is opportunity to improve on what we have here. First of all, by adding oxide leachable material to the resource, building on what we have, and we're seeing already in the drill results from this year that we will do that. But also with further test work, we've assumed a minus 2 inch crush for the leach on this operation as it's currently designed, and there's no reason why we can't improve on crush size, optimize for better recoveries through more engineering work and detailed study. That'll all follow as we progress towards taking this back into operation. But I think our starting point is a relatively conservative one, and one that we certainly think we can improve on.
In the meantime, you keep finding more gold. Assays are pending. Any feedback there on the turnaround times? I know that the labs in many places are busy, and so do you have a ballpark for us on when we can receive the next set of assays?
Yeah, that's the $1 million question. We'll hope to have some out, certainly before the end of this year. But I'm afraid a lot of our results aren't going to be coming out until January and possibly into February. So hang on to your seats here, guys. We've got lots of drilling to come, drill results to come, and we'll bring them to you as quickly as we can.
A lot to look forward to, Hugh. Thank you again, and congratulations.
Thank you, Gerardo.